Five companies, $700 billion spent in a single year. That's not a technology investment. That's a bet that could break free cash flow across big tech simultaneously. In 2024, the four largest hyperscalers, Microsoft, Amazon, Google, and Meta, spent $200 billion combined on infrastructure. 2 years later, that number has more than tripled. In 2024, combined hyperscaler Capex was just over $200 billion. In 2026, it's tracking towards $700 billion. No technology build-out in history has scaled that fast. Here's what nobody on CNBC is telling us: capital intensity for these companies now sits at 45 to 57% of revenue. That's not tech economics, that's utility company math. And utilities trade at 15x earnings, not 30x. Meanwhile, analyst projections warn that big tech free cash flow could drop up to 90% in 2026 as capital expenditure dramatically outpaces revenue growth from AI products. Meta's free cash flow already collapsed, dropping to just $1.2 billion in Q1 from $26 billion in the same quarter last year. The ROI math is the problem. Direct AI services generated roughly $30 to $35 billion in 2025, against approximately $332 billion in AI-specific capex. That's a 9 to 10% yield on last year's spending. Now they are doubling that denominator. None of the hyperscalers have demonstrated positive ROI on their AI infrastructure investments at scale. The debt story is what should concern investors. Hyperscalers raised $108 billion in debt during 2025 alone, with projections suggesting $1.5 trillion in total debt issuance over the coming years. These are companies that historically ran near zero debt. Hyperscalers are shifting from using operating cash flow to increasingly relying on debt market to fund AI-related capital spending. When the yield on that debt exceeds the yield on the infrastructure, you don't have a growth story, you have a carry trade.